Gold prices have been on a tear in the last week. Where are prices headed from here? Joining me today is Dan Oliver, founder of Myrmikan Capital, joining us all the way from the Minds of Money Online Connect. Dan, welcome to the show.
Well, thanks for having me.
This week, stocks are up, gold's up. What's going on? How do you feel about the markets? What's your sentiment?
My sentiment is if the Fed keeps printing, prices go up. I mean, that's what they do. That's their mandate, is to keep inflation at 2%. And of course, when the panic happened in March, their whole thesis was going off the rail, which is you got to keep inflation going or the whole system goes in reverse. When you have a huge credit bubble, when you have a bank system that's levered up 10, 20, 30 to 1, right, any decline in asset prices makes the whole thing unravel. So that's their mandate. It's been their mandate for decades, and they simply cannot allow prices to go down. So that's why they're printing money.
But I mean, 1766, 67 is where gold's trading today on Tuesday. We're seeing near record highs. We're not quite there at 1920 levels yet, but we're seeing a climb towards 2011 high levels. Like you said, the Fed's been printing money. Clearly, gold is not really being traded as a safe haven asset now, is it? Because it's going up in tandem with stocks. Would you agree with that statement?
Well, I think it's more complex than that. I mean, I think when we think about Fed printing, if we think more on a detailed basis, QE in 2009 is very different than QE today. QE in 2009 was about a credit collapse. The banks had no reserves because they'd lost a bunch of money, and the Fed's mandate was, okay, we'll print the money. What it really meant was we'll give the banks new reserves. They can lever up the reserves and fund capital assets. That's what banks mostly do, is fund buildings and ships and airplanes, that kind of thing. And that gives you the Keynesian sugar high. You get commodity prices rising because they need to buy commodities to build things. You get lots of employment, you get lots of tax revenue, all that stuff. And the normal cycle is you get overcapacity, and then rents fall because prices go down when you get too much capacity, and you want in a crash. That's a normal cycle. And this is very, very, very different. The government mandated a total shutdown of the economy because of the virus, and the Fed's printing money not to create that Keynesian sugar high, but to allow companies the cash they need just to make their payments. I mean, their current expenditures. And so this is not a credit inflation; it's monetary debasement, and those are two very different things. Both involve rising prices, but they're entirely different phenomena. And what we're facing is monetary debasement. Gold doesn't like credit inflation. Gold likes deflation. Gold loves monetary debasement, and that's what they are, and that's why gold's responding.
So just in the equities market, are equities investors pricing in a recovery to pre-COVID levels, or are they pricing in further growth from here? Because we're seeing the S&P 500 and a lot of broad indices stall at around current levels for quite a few days, maybe even weeks. It's having a hard time breaking past the February highs. What do you think? Do you think that the Fed stimulus is meant to grow the economy at 2-3%, or is it meant to just stop the economy from falling any further?
Yeah, when Powell was asked, are you worried about inflation? When the money printing in a recent conference, he said, well, there was no inflation in 2009. And again, it was totally different. And also said, we're just not worried about that. We're worried about survival right now. I think what the stock market's doing is, as you know, the entire corporate world has been a debt binge because the Fed lowered rates so far. They borrowed money to buy back their own shares. They became incredibly levered. What the Fed's doing now is they're saying, hey, look, we have to devalue the dollar. Well, if you're a corporation and you got a whole bunch of debt, and all of a sudden the real value of the debt's going down, that by definition increases your equity value. And so I think a lot of the equity run is a rational response to the realization of the market. The Fed is not going to allow these debts to bring down these companies. And as I say, therefore, even with lower growth, the equity value goes up. Gold is much more profound than it will be in the traditional markets.
And last year, you talked about $3,000 gold prices. Obviously, the monetary situation today is very much different than it was a year ago. How has your forecast changed? Has it changed?
Well, yes, it has changed. I'm at 10,000 now, and the reason is, this is the numbers that I've had. I mean, the way I look at the gold is not gold in terms of dollars. Gold has been money for 4,000 years because it's the most stable element. And so I think what's the dollar? And the definition of a dollar today is a unit of liability of the Federal Reserve. And so it's very easy. You say, okay, well, what are the Federal Reserve's assets and what are their liabilities, right? Well, their assets include some gold. They say they've 300 tons of gold on their balance sheet, right? And the other assets are treasury bonds yielding almost nothing from an totally insolvent Congress, right? And what's the liability? The dollar, that's what liability is. And so my point is that when you project a crash in the value of the other assets of the Fed, i.e. the mortgage bonds that they own, the treasury bonds that they own, all these new funky commercial debt that they're buying, some of it sub-investment grade. When those things crash, the Fed will find its assets completely stripped of value, or not completely, but a big impairment, and that will have a direct influence on the dollar. So if you just crunch the numbers, you say, what happens when the market stages a run on the Fed? What does that look like? What it looks like is the price of gold rising to a price that balances the Fed's balance sheet. And as the Fed increases the balance sheet size, that equilibrium number goes higher and higher and higher. And so the Fed, as you know, has been in a massive purchasing spree because of the virus situation. And so therefore, the equilibrium price of gold is going up commensurately. And so the numbers now to balance that balance sheet are enormously high. And as you also know, they had this idea, they can unwind this stuff. Well, that idea was exploded in 2018-19 when they tried to reduce the balance sheet and discovered they got a tiny bit into it and the whole economy started melting down. Don't forget that the financial situation was weakening way back in September, long before the virus presented itself. So this is not a virus story. This is a credit bubble story, and the virus just made it that much worse.
Okay, you've talked about the idea of excess capacity coming out of quantitative easing. Can you talk to us about how that would impact prices today and potentially how inflation could be impacted by excess capacity?
Yeah, sure. So the way a bubble usually works, the Fed prints a bunch of money. Right? More precise, the banks create the money through the fracture mechanism. The Fed's just there to backstop them when they get into trouble. So the banks do that. Rates go too low, and it's just basic economics. If you look at a discounted cash flow analysis, the more capital intense, the more long-term your cash flows of your project are, the more influenced they are by discount rates. So as discount rates fall, as interest rates, the cost of money goes down, it incentivizes rational economic actors to go build really long-term assets like real estate, like buildings, like all those fun things I mentioned before, right? And you get overcapacity, and when you overcapacity, you can't charge the same rate you could before. And so what happens is that those projects start to run out of cash to pay their debts. Now, usually what happens is the Fed runs in and prints a bunch of money to allow them to keep doing that. What's happening now is this is like a perfect storm where the whole world was busy building this overcapacity, and then all of a sudden demand went to zero or close to zero. And so it became very starkly evident how mismatched investment has been to consumer demand. And so the Fed's only choice to keep this pyramid from falling over is to print enough money to create demand for that overcapacity. And that is a very large number indeed, and that's what they're doing.
The Fed has shown us that the new reality is just stimulus whenever there's trouble. Would that statement be accurate, do you think?
I mean, that's been accurate since the 1920s. So yeah, nothing new there. What's new is the magnitude of it. That's what's changed.
If the Fed can just declare that additional money printed actually does have value, what's stopping them from indirectly declaring then that competing assets like gold shouldn't have value? We've seen Nixon take gold off the gold standard, in the 70s. What's stopping the government from just saying, hey, look, the dollar is really the most important fiat currency or any currency today, and that's what investors should be buying?
Yeah, I think one of the fundamental lessons of history is that economics are more powerful than government. I mean, Nixon might have said gold's not money, but when you look at the way gold behaves, it hasn't changed at all. What's changed is the dollar. If you look at the gold commodity ratio, for example, and you over a couple of hundred years, you can't see where 1971 is because some president says gold's not money. That doesn't mean the market stopped making it money. Gold is still money because it's the least volatile element. You can see that if you look at oil price in terms of dollars since 71, the annual standard deviation is 64%. You look in terms of gold, it's 40%. So the market still prices gold as money, and so it doesn't matter what the Fed says. Now, again, right now, the Fed has power because the dollar is a global reserve currency, because there's $90 trillion of dollar-denominated debt. People need dollars to pay their debts, and that creates a lot of demand for dollars. That's true. But as other countries, regional countries, systems like Russia and China peel away from the dollar in the Middle East, as people either pay their debts back or don't take debts out in dollars or default on them, that demand goes away. And the Fed's printing so much money that the danger is people have enough money to pay their debts back, and then all of a sudden the demand for dollars goes way, way, way down.
Yeah, so the other issue you brought up is the issue of gold miners' valuation. And you talked about offline how gold prices don't really need to go higher for miners to do well. What's holding them back, Dan?
Yeah, I was talking mainly about junior miners, the space I operate in. When gold runs, what happens is fast money investment funds just buy the GDX. It's easy to do. You know it's going to go up, they go up. So all the big companies get the big capital first. It's the smaller companies that are more levered to gold. And they haven't really run as fast. And why not? Because it takes a lot more work to find out who they are, where they are, to get comfortable with the projects, meet some management, all those things. And so what I'm seeing is that what's really holding back the junior space is they have projects which at current prices are ridiculously profitable. The problem is that there's so little capital to fund them that the market knows that they're going to be diluted when they go out to fund their projects, construction projects, whatever it is, and that keeps the equity low. What's changing is that all of a sudden generalist capital is scared and looking for opportunities in this space. And for the first time in 10 years, I'm seeing competition to fund some of these construction projects. And that's going to drive the cost of capital lower for these projects, which makes the equity value worth a lot more. So my point is that gold's already high enough that almost every project out there works tremendously well. So what we're waiting for is the generalist capital to lower the cost of capital for these companies. Once that happens, watch the junior equity markets go bananas.
What about the seniors? Because the GDX has actually beat the S&P 500 year to date. How do you feel about valuations right now?
Yeah, no, the seniors are great. I mean, of course, like their input costs are going down and their output costs are going. You have revenues going up. I mean, of course, they're a great business to be in, obviously. And when you're running huge amounts of capital, you can't mess around the junior space. You can just get big guys. But in the gold space, it's so small. There are very few big companies, and so they get bid up right away, really quickly. They always get the money first. It always happens. But then, as I say, the real opportunity is in the smaller names that aren't in that stream of liquidity, where it's really easy for some guy to say buy GDX. And GDX goes and buys his components. That's harder to do, but once the capital gets there, what's nice about the gold space is that it's really inelastic. A lot of these projects take 10, 15 years to get to development stage. So once they get properly valued, it's not like a whole bunch of new projects come online. It takes a long time to get good projects. And so again, once the market figures out that there's a limited supply of these things, now profitable they are, I think that you'll see a radical change in price. If gold is anywhere near those levels, obviously gold keeps going up, and I think it will. That'll make it better. But that's the real transformation we're waiting for is generalist capital to come into the junior space.
Okay. Last question for you, Dan. How do you feel about investments overall post-COVID? We've seen so many businesses fail. Some investors have argued that they were going to fail anyway. This just expedited the process. A lot of tech companies have done very well, and some fund managers have shifted allocation that way. What's your personal sentiment? How has your thesis changed?
Yeah, my personal sentiment is that if you're a really big company, you can get free money from the Fed right now, right? And so you're not going under. And if you're a little company, good luck to you. I mean, there are programs you got to apply. It's difficult. You get denied. You don't fill the box in right. Whatever it might be, they're running out of money. So one of the effects of this is going to be is that economic power is going to concentrate even more. I mean, the banking system concentrates economic power anyway. If you look at any industry the last 30 years, there's been massive amounts of concentration. But this will just accelerate that process. And as economies concentrate, the consumer really gets hurt because you wind up with monopolies. When you wind up with oligopolies, you get less consumer choice, you get higher prices, and the work gets worse. There's less competition for workers. It's just a disaster. And so I think that the effect of this is going to be a much worse economy going forward with less opportunity for people, but also the only thing that keeps this thing going is accelerating money printing, and that's going to help the gold space, and it's going to help the junior space most of all.
Could this happen when investors wake up one day and the Fed just declares that they're going to stop printing money? Would that be a real risk?
They can't do that. I mean, because remember, the biggest there on the planet is the federal government, right? So it's all very nice to say, well, look, like in the housing bubble popped, I mean, who got wiped out? The strippers who owned 10 houses, they were in trouble. But the average guy, they saved the average guy long before he was going to default because they had to. Because if that guy fails, the federal government fails, and the big companies fail, and the banks fail, and they can't allow that. So yeah, if you're way out in the curve, you might have problems. But as long as you can survive longer than Chase, you're going to be okay because the Fed's never going to let that happen.
Fair enough. All right. Fantastic thoughts from you, Dan. Thank you very much for joining me today.
Thanks for having me.
And thank you for watching. We'll have much more for you from the Minds and Money Online Connect conference. Stay tuned.